Trading Finance. Today's video we're talking about option Greeks. What is the option Greeks? If you're watching this video, you probably understand the basics of options by now. Options are a financial contract that give you the right but not obligation to buy 100 shares of stock at a certain price at a certain time. Okay. Options are a type of derivative, which means it derives its value from something else. And that something else is an underlying stock. But options don't entirely move the same way stocks move. An option's value changes over time with respect to changes in certain things. And these changes in certain things is what makes an option sensitive. That could be a change in stock price, a change in volatility, a change in interest rate, and where it is in its lifespan. Because options have expiration dates, like you and I, options die. They perish, they cease to exist after a certain day. These options are priced by the exchanges, and the exchanges uses option pricing models. You probably heard of Black-Scholes model, binomial, trinomial option pricing models. They use these models to find the fair value price of these options. And the inputs they use in these models are the stock price, volatility, risk-free rate, and time until expiration. So those same things is what makes an option sensitive. And we can measure those sensitivities using the Greeks. If you have a large portfolio of options, the Greeks will help you manage risk. It'll help you see how your portfolio may react in certain market conditions. So these sensitivities are measured individually using these Greek terms: delta, theta, rho, Vega. Those four are the first order Greeks, and they're what makes the option sensitive. You have second order Greeks, third order Greeks, and we'll get into that, but some Greeks are more important than others, starting with delta. So delta is the first Greek we're going to talk about. Delta is one of the more important ones because it takes up so much of the option value. Delta expresses the amount of price change a derivative will see based on the price of the underlying security, a stock. So simply put, delta is how much your option contract will gain or lose with a $1 move in the underlying stock. So we're going to use Alibaba as our example. Delta's value ranges from 0 to 1, and it can't go above 1. And as you can see, deltas change based on where your strike is. The farther out of the money you go, the lower your deltas are. Deeper in the money you go, the higher your deltas go. So you can look at deltas the same way you can look at how many shares of a stock you have in your portfolio and how that would react to a $1 move. Let's say you had 49 shares of Baba in your portfolio. If Baba goes up $1, then your portfolio gained $49, one representing each share you owned. So essentially, think of that the same way you would think of deltas. We're going to look at this strike. The 240 strike, it's trading at 745, 790, so we'll say 750 with a 48-cent delta. So with our example, Baba is at 237.75. The option price as of now is 750 and the delta is 48 cents. So if Baba decides to go up $1 to 238.75, you would then add that 48-cent delta to the option price. So the new option value would be 798 because it's 48 cents plus the 750. Because you got a $1 move, because delta represents how much money your option value will gain or lose with a $1 move in stock. Baba goes up $1, you gain that delta hops onto your option price, which is now $7.98. But you got to take the good with the bad. If Baba decides to go down $1 to 236.75, then that's the amount of money you would lose on the option value. So 750 minus 48 cents is now 702. A $1 move, gain or lose the delta. But delta is not constant. Delta changes based on how deep or how far out of the money you are. Delta also represents a probability factor that it's in the money at the time of expiration. If I have a 48-cent delta, that means there's a 48% chance that it'll expire in the money. So I've been using calls as our example, but there's delta in puts as well. Deltas on calls go from 0 to 1, meaning you get positive delta if the stock price increases, but with puts it's the opposite. Puts go from 0 to -1. So it will be negative delta if the stock price goes up, you'll lose money. You'll gain money if the stock goes down. It's just flipped. So the next Greek we're talking about is rho. Rho measures an option sensitivity to changes in interest rates. How much option premium will change if the risk-free interest rate increases by 1 percentage point. When people talk about the risk-free rate, they're usually talking about United States government bonds, treasury bills, and the reason it's called risk-free is because it's essentially the safest place you could put your money. If you lend money to the US government, there's a good chance they'll pay you back without defaulting. They've defaulted in the past, but US government bonds are still seen as the safest investment because you will get your money back with interest. The interest isn't much, but you'll get something. The interest rate is set by the Federal Reserve. The Federal Reserve, you heard of Jerome Powell, he's a stud. And they have these meetings throughout the year. The interest rate that they set is usually the prime rate at which they lend to other banks. Banks make their money from lending, but they do need to keep a certain amount of money in their banks at all times by law. So the rate at which the Federal Reserve lends the banks to meet these requirements affects how the interest rates as a whole comes out. Because if the Federal Reserve has lower interest rates, then the banks could give their customers lower rates. But if the Federal Reserve raises rates to fight inflation, then the banks are going to be like, okay, now we have to raise our rates because, it's becoming more expensive for us to borrow money, so we need to make a profit too. The customers, me and you who want to go in the bank for a loan, they're going to say, hey, we're going to need a higher rate because the Federal Reserve has a higher rate. So, they changed interest rates due to inflation, due to encouraging spending. Like I said, interest rates don't change all that much. Unless you're buying leaps, options that expire 2-3 years down the line, then RO may not affect you all that much day to day. But what RO stands for is important. It is important to understand interest rates and how interest rates affect the markets. Lower interest rates mean it's cheaper to borrow money, which in turn means, hey, if it's cheap to borrow money, let's throw this in the market. Wouldn't that make sense? Out the blue, if they say, okay, we're raising rates, and they raise it quickly, and they keep raising it quickly, then you're going to see an effect in the markets. You're going to see a dip in the markets. Just like in end of 2018, I think, they started raising rates. President Trump wasn't happy about it, and the market started to see a dip. Keep up to date with interest rates. You can go to the Federal Reserve website. My FX Book is an app that I have that keeps you up to date with economic events. If the Federal Reserve raises interest rates by 1%, then your option contract will gain whatever the RO is. Whatever is usually a small amount, but it's still there. So the next Greek we're going to talk about is Theta. Theta represents the time decay of an option, or how much the option value loses every single day. Options have expiration dates. There's a time limit to be correct. It's not like shares where you could say, hey, I think the stock's going to go up. You hold shares and you could essentially hold it until you're correct. When you buy options, Theta puts accountability on you. So you think the stock's going to go up? Okay, it better go up before it expires. So as you can see, the contracts we were looking at before have a negative 21 cent Theta, which means as long as you hold these contracts, you lose 21 cents on the option value, which is a pain in the butt. It's negative for either calls or puts, so you can't run away from it. But if you take the other side of the trade and you sell options, your Theta will be positive. So you will collect that 21 cents a day for selling options. It's one of the benefits of selling options. So this is my graph. Obviously, it's not going to be perfect because I freehanded this, but essentially it shows the longer amount of time you give yourself, the less you'll lose in Theta every day. But as you get closer to your expiration date, that's when Theta starts to pick up, it starts to increase, and you start to lose money faster. And the rate at which you lose money changes based on if you're in the money or out of the money. If you're out of the money, you lose money even quicker because you have less of a probability to be in the money at expiration. But if you are in the money, you'll still lose money in Theta, but it'll just be slightly slower. So that's Theta, time decay. You lose money every day from holding options. Next, we have Vega. Vega measures an option's price value relative to changes in implied volatility. Vega measures how much you gain or lose on your option contract with a 1 percentage point change in volatility. So for example, let's say Bob is at 237.75. Our Vega is 0.23. Volatility is 42% or just 42. Option price is 750. So let's say volatility rises 4 points from 42 to 46, 4 percentage points. So you would take your Vega, 23 cents times 4 equals 92 cents, and then you would add that to the option price. So 92 cents plus 750 is equal to 842 would be the new option if volatility rises. If everything else stays the same and just volatility rises, your new option contract will be worth 842. Also, if it goes down 4 points, let's say to 38, you would subtract that 92 cents from the 750 and the option contract will be $6.58. A bummer. So implied volatility is what the market is expecting or predicting volatility to be in the future. It's set as a percentage form and it's looking annually. Now we know volatility changes out the blue. It could change day to day based on changes in political or economic events. It could changes in interest rates or earnings reports. So you don't want to use implied volatility like it's perfect. It is implied. It is some sort of a prediction. So Just keep that in mind. But what implied volatility does tell you is what the market is expecting a certain stock to do within a year's time. You should know a little about standard deviation. Standard deviation is just a measurement of variance between a set of values. If we're looking at stock price, how wide the price swings are. Something with higher IV has wider price swings. One day it could be $100, the next day it could be 130. Those are more volatile stocks, and those have higher implied volatility. Lower implied volatility stocks move less. They have smaller variance where the stock price doesn't move all that much throughout the year. Let's say you're looking at a $50 stock with an implied volatility of 40. That means within a year's time, you can expect that stock to go up or down 20 bucks. That's 40% of 50 is 20, and that's how they look at it. You got to look exactly why implied volatility is changing. Let's say implied volatility goes down. What would cause implied volatility to go down? Well, for example, let's look at an earnings report. You ever buy out of the money calls right before earnings and the stock goes up just like you predicted, but your option value went down? That's an IV crush or implied volatility crush. The market was expecting a certain move from this stock, but the realized move, the move that actually happened, was less than what the implied move was. So it under-delivered. It didn't meet expectations. And with implied volatility, you don't want to just look at it through a one-day lens. You may look at a stock where it says, oh, this is 40% implied volatility, that must be high. Well, if you look historically and it had a 60% on average, then that would actually be low. You want to look at historical volatility, implied volatility, and realized volatility. So I will do a video on volatility as a whole in another video because there's a lot of stuff to talk about when it comes to volatility, but for this, we'll keep it short. So the last Greek we're going to talk about is gamma. And gamma would be a second derivative because it derives its value from delta. And delta derives its value from a change in underlying stock price. So you need the delta to get the gamma. And like I said before, delta isn't constant. The rate at which you get from 0 to 1 in a delta isn't a constant move. It's not like it goes up from 0 to 0.5. Who's getting arrested? The rate of change is the gamma. And the gamma varies based on if it's in the money, out of the money, at the money. And gamma is the rate of change for an option's delta based on a single point move in the delta's price. So I'm using this picture as an example. I got this on Google. I want to thank Project Option for drawing this out for us. What you can see is when you're out of the money or in the money, your gamma value is essentially 0. Well, we know that deltas don't change all that much when you're way out of the money or way in the money. And if the deltas don't change much, then that means the gamma value would be very low because there's no rate of change. An out of the money option with a 0 delta can't go below 0. So as it gets closer to 0, there's less rate of change. And deep in the money options, if you're getting closer to 1, as it can't go above 1, the gamma value would be lower because, once you get around that 1 area, you're not going to go beyond 1, so it's not going to be changing at a faster rate. But as you can see, when you're out of the money and you get in the money, when the stock starts to rise in your favor, then your deltas start to pick up, and the rate at which they pick up is the gamma, and the gamma is highest at the money, right when you're at that 40, 60 cent delta mark. As you get closer to that $1 mark, it slows down again. If you're buying calls or puts, you have positive gamma. If you have an option with high gamma, that means the value of the options will change at a faster rate. If you have high gamma and it goes against you, then that means you lose money at a faster rate, or you lose value at a faster rate, I better say. So that's gamma. Gamma is how much the delta moves. Delta isn't constant. Delta varies based on if it's in the money, out of the money, and gamma measures that movement, that rate of change. Now, I could talk more about Greeks. There are more higher order Greeks. You probably heard of charm or vana or speed, but they're not really important to everyday traders or investors. If you're on an institutional level, that's going to be more important. It's not so easily available. So that's the video, the option Greeks, the Greeks that everyday investors should know about. If you learned something, if you like the way I explained it, hit the like button. This topic is very competitive. You're going to see a bunch of option Greek videos on YouTube. I'd appreciate all the likes we can get just so we can get our video up there. And I don't want to resort myself to making these goofy faces for views. This is an educational channel, so if I left something out, you think, hey, Evan, you look handsome, but you might have left this part out. I think it's important for beginners to know. Boom, you're pinned. Leave it in the comments if I left something out. If not, comment some video ideas. We're not so creative. We need ideas for videos. I'm out. I'm going to bed.